So let's talk about the mortgage payment. Mortgage payments are constructed of four things. In your mortgage monthly payment, you got the principal and interest, which is the main parts. If you have a fixed rate, that does not change. So it can be a 30-year mortgage or 20-year or 15-year mortgage. That amount is fixed until you pay off the loan. We obviously know that in the beginning part of your mortgage payments mostly go to the interest and the least of it go to the principal. And then as you pay, that amount starts to adjust. So you're kind of reaching like the midterm of your loan. Most of your payment is going to go more towards the principal than the interest, and so on until you pay off. But that's the reality. You know, that's how lenders have so much money they can lend to us to buy homes here. So it is interesting to know, if you own a home, how do you pay that home quick? One strategy I do use is, pay an extra payment a year. So if it's like 12 payments is 1 year, do a 13th payment. Do one extra payment. That'll cut off maybe 5-6 years of your term. So that's a good tip right there. You're trying to pay off your mortgage and avoid interest rates, right? The other thing that composes the payments, the escrow, which is composed of taxes and insurance. And for you that has mortgage insurance, which is the PMI, like the FHA loans and conventional loans, if you did a minimum down payment, that's going to be part of your escrow. Now, most people that call me and say, hey, Felipe, my payment changed. It's not the first two parts. It's not the principal and interest. That does not change if it's a fixed rate, okay? Unless you have an adjustable rate. The other part that composes that payment, which is the taxes, insurance, and the PMI, the mortgage insurance won't change, but the taxes and insurance may change, okay? Your insurance may go up for some reason, right? We're living in an insurance crisis, you can probably call that, I don't know. Some people see their bill of insurance go up high, or they put a pool in and the insurance climbs up. So that may change. Your taxes may be something subject to change. Maybe there was an assessment in your house. Maybe there were improvements to your town and everybody's taxes went up. So just make sure if anything changes in your payment, you want to tackle first is your escrow. And you may have it in your favor. Your payment may go down, and it may be because you have enough equity in your property that you don't need mortgage insurance anymore. Most conventional loans, or actually conventional loans, you should be able to call your lender and say, hey, I have enough equity where I don't need the mortgage insurance, so please remove the mortgage insurance. And that may save you, maybe $200, $300, maybe a little less a month. So if you do have equity in your house, do look into that. But if your mortgage does change, those are the reasons. Your escrow must have changed. So just keep note of that and just take a look if you see any adjustments on your mortgage payment. Any questions too, reach out. If you're looking to refinance, lower that payment, or maybe you want to change the term, a lesser term, and pay off the house quicker with a built-in strategy, give us a call. We'll help you get that done. And maybe you're tapping into equity, trying to get some money out of the house, so house improvements. Maybe you want to finish your backyard. Maybe you want to add a new pool or buy other properties. I don't know. You can use that equity for that. So give us a call. We'll help you with that. And anything to do with your mortgage, just let us know. We'll give you the best tips and the best strategies to save you some money. Thanks.